Hello, I am Professor Donna Byrne, and this is an estate and gift tax online video about introductory tax concepts, a little bit of income tax review, and that's about it. Okay, so first of all, when we talk about taxes, usually we're thinking about two things. First, what is it that's being taxed? And second, what are the tax rates? Now, if you've taken income tax, this should be review for you, but that won't hurt. If you haven't taken income tax, please read the early chapters pretty carefully and ask if you have any questions. So the tax base is the part that's subject to tax, and that's what we'll be looking at first. If you think about different kinds of taxes you have known, usually I ask this in class, and these are the ones people come up with. The income tax, capital gains tax, property taxes, sales tax, excise taxes, and then of course the gift tax and the estate tax, because that's why we're here. Each one is characterized by a different thing that's being taxed, and that's what we call the tax base. So for income tax, we are taxing annual income. So we do this every year, and we start over at the beginning of every year, and it's whatever new wealth comes in. The capital gains tax actually is a part of the income tax. Gain is a kind of income. Capital gain is a special kind of gain. And so this is really just part of the income tax base. The capital gains tax is a lower rate than the regular income tax. So most people think of it as sort of an extra tax. Actually, it's a lesser tax. Property taxes. Usually we are thinking about tax on our house, but actually that's a real property tax. It's possible also to have personal property taxes. Now think of if you've been taxed on anything based on its value each year. That's a property tax. In Minnesota, when we pay for our car tabs, the amount that we pay depends partly on the value of the car. That's a property tax. It's based on the value of property each year. Sales taxes. We're mostly familiar with sales taxes unless you live in Delaware, home of tax-free shopping, or Oregon, or it seems to me there's someplace else. Live Free or Die, New Hampshire? Could be. Okay, so a sales tax is imposed on the value of goods that are purchased, so that makes it a consumption tax, actually. And it's a general kind of tax, which is what distinguishes it from an excise tax, which is imposed on particular kinds of transactions. Sometimes they are retail sales, but they could be other different kinds of things as well. There are lots of excise taxes. They don't usually get quite as much attention. Now the estate and gift tax go hand in hand, and there's also a generation skipping transfer tax. The wealth transfer taxes are based on the amount or the value of wealth that is transferred gratuitously. So the value of wealth that you give away or leave to people when you die. The estate tax is based on the decedent's estate that's transferring to other people. And the gift tax is based on wealth that's transferred during a lifetime. Okay, sometimes people object to the estate tax because they feel like it's a double tax. They say, but that money was taxed when it was earned. Okay, maybe true. But that was the income tax. That's a totally different thing. It's just like we don't think of it as double taxation when we earn money and pay tax on it and then have to pay property tax or sales tax. They're different taxes. So what we're looking for is, with the rule against double taxation, is that we don't want to tax the same thing to the same taxpayer twice. Now, sometimes wealth wasn't earned as income. Sometimes we inherit it if we're lucky enough. And now maybe we'd say, well, okay, it was taxed already under the estate tax when my grandfather left it to me, or my father, or whoever it was. Yes, it was, but that wasn't the same taxpayer. So that's not double taxation either. The idea of the wealth transfer taxes is to tax the transfer of wealth each generation. So we don't mind that somebody else paid wealth transfer tax, just like we don't mind that somebody else paid income tax on the money that they used to pay you. Okay? So it's not double tax, it's a different tax. Okay, so another little starter item to clear up: the difference between an inheritance tax and an estate tax. We're going to call this the estate tax. That's what we're focusing on, and it's important that you understand that it's not an inheritance tax. An inheritance tax is imposed on the value of wealth inherited by a particular beneficiary or heir. That means that the incidence of tax really is on the beneficiary, and it means that it matters who the beneficiaries are. Now, an estate tax is based on the total value of the decedent's estate, and for the most part it doesn't matter who it's going to. There's no federal inheritance tax, only an estate tax and a gift tax. And I will mention, though, that under the federal income tax, amounts received as inheritances are excluded from the income tax. They're not taxed. So we do not tax inheritances. We tax the transfer of the estate. There are only a few states that even have an inheritance tax. Most states have an estate tax if they have anything. But one of those states is our neighbor, Iowa, and there are a few others. I haven't looked all of these up to see if this is still correct in 2015, but Indiana, Iowa, Kentucky, Maryland, Nebraska, New Jersey, Pennsylvania, and Tennessee. Okay, now in Iowa, our near neighbor here from Minnesota, the inheritance tax is imposed on the decedent's estate that's transferring to people unless they are exempt persons. Now this is pretty typical of an inheritance tax. We look to see who is receiving the property, and some recipients we don't tax. So typically we don't tax wealth being transferred to a spouse. We'll see that under the estate tax and gift tax as well. Under an inheritance tax, often we don't tax what goes to children. And in Iowa, it's spouse, all ancestors, all descendants. Now, who's missing? Right, that would be your twin sister or twin brother, right? There's nothing about siblings in this list, or uncles and aunts, or cousins, right? But straight up or down your line, ancestors, descendants, no tax. Okay? Now, under the estate tax, the only person that gets that kind of treatment is the spouse. So we do have a deduction for transfers to spouses, and we'll spend some time on that. Okay, so let's talk about some basics of how we go about calculating tax. In the income tax and the estate tax, we start with a gross amount, a big number, everything we can think of. So we start with gross income under the income tax. We start with the gross estate for the estate tax. Same idea. And then in both situations, we subtract deductions. And we'll talk about what a deduction is in a minute. And that brings us to the taxable income or the taxable estate. And that is pretty much what our tax base is. So most of the fun is deciding what belongs in the gross estate. And then the rest is figuring out what is deductible. The tax calculation, I don't want you to get hung up on. That's the part calculators and computers do really, really well if you put the right numbers in. So figuring out what things go into those right numbers, that's the fun. Okay, deductions. Deductions are things that got paid out that we get to subtract. And the one that most people are familiar with, it works in the income tax, it works in the estate tax, is charitable contributions. If I pay charitable contributions during my year, I get a deduction for income tax purposes. If I give money to charity, I get a deduction from the gift tax for gift tax purposes, or a deduction for estate tax purposes. It's something I paid out and we get to subtract it. Exclusions, on the other hand, are amounts that don't count at all. We never add them in the first place. And so this is something that in the income tax we receive, right, that should have been income, but Congress in its wisdom said no. So under the income tax, gifts are excluded. Sigh of relief, right? So all those gifts that you've ever received for birthdays or holidays, not gross income. They are excluded. Even though that's something you received, it's new wealth for you, it's excluded. Under the gift tax, now the gift tax, remember we're taxing wealth that you transfer away. So under the gift tax, some of those transfers are excluded. And one of the easy ones is if you pay tuition for somebody, that's not a gift. It's excluded. There's also an annual exclusion that's not on the slide, so I'm not going to talk about it. Okay, a credit is a different kind of tax break. This is a dollar for dollar reduction in the amount of tax. Once we figure out the tax, we can subtract credits from the tax. So under the income tax, you may be familiar with the lifetime learning credit. It gives you a credit for part of the amount you pay as tuition, and that goes for anybody. It is income limited, but it's available. It's a tax break. Under the estate and gift tax, we call it a unified credit. That's a credit for the amount of tax you would pay on the first $5+ million. So you could think of it as like a voucher that pays part or all of the tax. Okay, now shoot, there's more. Hang on, there's more.